Right. What's up, everybody? We are back for another kind of mini training. Today, I wanted to talk about how to evaluate or evaluate multifamily properties very quickly, under 5 minutes. We've got our full case underwriting framework, but sometimes you're just out in the field or you meet with somebody or somebody sends you a deal and you just need to like be like, hey, is this even worth my time underwriting? Is it on the fringe? Is it anywhere close so that I can dig in further, find the information that I need to actually do a proper underwriting on this thing? So I want to show you guys just a few techniques that we use. Again, I'll keep this super short, hopefully within 15 minutes. And it might be something that you can use to kind of, save some of your time, find what deals are kind of a no-go, ones that you might want to dig a little bit further into. And it kind of, it at least helps me kind of push away the tire kickers, the ones that aren't even worth taking a look at. So I'm going to share my screen here. Just got a simple Word doc I'm going to pull up. Um, so analyzing deals in 5 minutes. So the first thing, my favorite way to do it is to kind of this back of the napkin math. So basically, you don't always have all the information on properties, whether it's on the market or a seller says, hey, I'm bringing you this property that I'm going to have for sale, but they don't have all the information for you up front. So one way to kind of find what your value or purchase price should be on that property is, as long as you know what the rents are that are current, most owners at least know that, you should be able to take that rent number. So let's just say this property was bringing in, let's say it's a 10 unit property. It was bringing in $1,200 a month per unit, 12,000 a month for 12 months. That's $144,000 in gross rental income. That's not with any expenses taken out whatsoever. So gross income is $144,000. If you don't know the expenses, which a lot of owners, they're kind of like wishy-washy on if they know exactly what their expenses are or not. If you don't know them, one way to run this is with a normalized expense ratio. Some properties are a lot higher, depends on taxes, it depends on insurance, depends on if the owner's paying for utilities. But if we're normalizing this and we want to try and find a valuation, a lot of times we'll use a 35 to 40% expense ratio. That's kind of tight. So if you really want to stress test these numbers, make that expense ratio a little bit higher than what you're seeing here. But let's say on this property, we're going to run it at 40% just to play it a little bit safe. So 40% of the gross rental income is about $57,600 a year. So that will include our projection. These aren't concrete numbers. This is back of the napkin math. That will include our projections for property management expenses, vacancies, taxes, insurance, any other like operating expenses, accounting, repairs and maintenance, any of those things that go into that operating budget, that should be included in this expense ratio. So that's what that 40% is covering. So then we take that, I'm sorry, that's not divided by, it's subtracted by. So you take that gross rent income, subtract it by your 40% expense ratio. That should give you your projected NOI. Again, just keep in mind that these are not, concrete numbers, but we're just trying to see if we're anywhere in the ballpark of what this seller wants for this property. So $86,400. We know that in this area, it's pretty safe to run it on like a 7% cap rate. So if you want to find a valuation on a multifamily property with a cap rate, you take that NOI number. So this is our NOI, what's left over after expenses come out, not including your debt service. And then you divide it by the cap rate. So we said 7%. So that would be 0.07. And that gives us a valuation of 1.235 million roughly. So 1, 2, 3, 5. That's actually 234 to 85 valuation. So back of the napkin math, if this seller's asking $2 million and they had that number in their head, you took their gross rental income and you said, I'm just going to put a 40% expense ratio on there, which these days, like that's actually might be, pretty close to being too low. You really got to dig into those numbers. But if they want $2 million and your valuation on this back of the napkin math is coming out of 1.2, you better be able to justify why, what you're missing. You know, how is this possible to get a $2 million valuation out of a property that, is probably running around at 1.2 after a 7% cap rate? They might be trying to sell it at a lower cap rate. You can run this same scenario. If it's a class A property, let's say you use a 6% cap rate. So use those NOI numbers, 86,400 divided by 0.06. If they're selling it that brings it up to 1.44. Still not even anywhere close to touching $2 million. Now, flip side of that, if an owner said, "Hey, I'm hoping to get $1 million out of this," well, you look at it and say, "Okay, well, I ran it on a 7% cap rate, 40% expenses. It's coming in at 1.2 right off the bat. They only want $1 million. Maybe I can talk them down a little bit more." This is a property that I might want to kind of dig into and look at a little bit further, even if it's a little bit higher than the 1.2 number. At that point, you say, "Okay, it might be worth my time to dig into what the actual expenses are on this property, so that I can really see where we're coming in at valuation when we go to it." So that's one way to do it. That's my like fastest back of the napkin method. Another really quick one is the price per unit. So we'll take Roanoke for example. I know from looking at comps, looking at for what things have sold in the area, you basically take the purchase price, you divide it by the number of units in that property. Now you want to know, are these all one bedroom units? Are these a mix of two beds and one beds in this apartment building? Is it just twos and threes? Because that changes what that price per unit can look like sometimes. But if you're looking at other comps in the area, you can get on Crexy, you can get on LoopNet, you can look at what things have sold for and what the unit counts are, what types of units they are. Are they all two bedroom units? So let's say there was a property for sale that was, let's just say it sold for, let's say they were all two bedrooms and they sold for, um, let's say 105,000 per unit. And you've seen three properties with exit comps at 105,000 a door. Now you want to look at the class. If they're class A properties and they're selling at 105,000 a unit, but you're buying a class C property, you know that there's going to be a delta there between what I buy it for. If I've got to get it from a C to an A, it's going to take a lot of capital expenditures to be able to get it up to that amount. But if the property you're looking at is trading at 70,000 a door, and let's say these are class B properties, class B comps, and you're buying at 70,000 a door, you should be able to tell, okay, well, as long as I can take this C property to a B property, get it stabilized, get it running properly, there is some room here on where I can buy it at, what I can sell it at. Now, again, this is kind of back of the napkin stuff. If you're buying at 70 and you're trying to get up to a class B property, you really got to start digging into, what am I going to have to put into this property to get it up to a B? Now, if you've got to put $30,000 in every single unit, which is a lot, if you got to put 30 grand into every single unit before you can sell it as a class B property, that brings you up to 100,000 a unit. You're not going to be selling for much of a profit if you're selling at 105. And these valuations on the exits are more geared on cap rates and things along those lines. But this is just a way to say, price per unit, what are they asking for this property? Based on the comps, what have they been selling for, price per unit? And then you can kind of back into, all right, do I want to spend more time trying to underwrite this property and really figure out, what the numbers look like? So, that's a good way to do it. The price per unit in Roanoke, I know if I can get anything, depends on the area, but if I can get anything under 80,000 a unit and I can bring it up to class B, they're selling for anywhere from 105 to even sometimes like 115, 120. So that gives me a pretty good delta in there to come in, do repairs, do upgrades, do things like that, get it operating better. And then I should have a pretty profitable exit on the back end. So that's another one, another kind of tactic there that you can use to to really just like speed things up or save a lot of time on stuff that, if somebody's asking 125,000 a unit, but it still needs CapEx upgrades to do your value add plan, there's not going to be a lot of room left to actually make any money on the exit. So this is just a quick way for me as I'm scrolling through Crexy or a broker sending me a lead, a property opportunity, something like that. I can kind of say, look, they're already wanting 120,000 a unit. This is a Class B property at best right now. Um, not enough meat left on the bone for us to look at it. And then the last one, this one's pretty like standard. Look at what the cap rate is coming in. So if they're trying to sell it at a 5.5% cap rate and it's a Class C property, and you know that you're going to have to put a lot of work into it to get it up to snuff and exit, then at best you're probably selling that Class C property at a 6% cap rate on the exit. You got to know your cap rates, you got to know the market. But again, current cap rate, what are you buying it at versus what your exit cap rate is for that valuation? And then what do I have to do in the meantime to do my value add plan and add value to the property? If you're buying it below the cap rate that you're trying to exit at, probably not going to be, a ton of room there unless you're, getting it at a pretty low price, even at a 5.5% cap rate. So that's kind of the three methods that I use. I won't get into the cap rate valuation too much because there's a little bit more intricacy into that. But just pay attention to what that cap rate is when you buy it, because you want to be buying it at a higher cap rate than you're trying to exit. So that's really the whole point of number three. So I hope that's helpful. I know it's kind of like there's a lot of like unknowns in this, but it'll save you a lot of time as you start going through and just doing back of the napkin math. Somebody just sends you a one-off opportunity. If you're like us, we're getting 4 or 5 opportunities coming in every week or every 2 weeks, and you want to save your time to underwrite the ones that are actually have some promise versus just spending time underwriting every single deal that comes your way. So this is the best way that we've found to really analyze these multifamily deals. A lot of times it takes less than 5 minutes, and you could say, all right, put this one in the potential category, or hey, this one's a no-go. They want way too much for it. Unless the seller's willing to come down quite a bit, which in some cases they are. Everybody likes to shoot for the moon. Then it kind of goes in the no-go category. We'll keep an eye on that one and see if it's still on the market in 100, 200 days. And if they've adjusted the price or they've adjusted their cap rate or whatever, we can come back to that down the road. So hope this is helpful. We're doing one of these trainings every other week. If you're not in the school group already, make sure you join that. We break these down a lot in there. We post deals in there. And this is the type of stuff that we go through in our multifamily sprints on actual properties. So if you don't know what the 90-day multifamily sprint is, we run one every quarter, and we have 4 seats for each cohort. We actually come together, create a partnership together, and go out and take down a 10+ unit multifamily property together with Haven as the operator, so that you don't have to create a second job for yourself, and you're able to get your first or next multifamily property under your belt. So stay tuned. Drop any questions in the comments. Send this video to anybody that you think might be interested, and we'll see you on the next one.